The world of renewable energy, especially residential solar, it's really buzzing right now.
It absolutely is.
It feels like everywhere you look, someone's putting panels on their roof or maybe adding a battery system for backup power.
Yeah, the interest is definitely growing.
And right at the heart of a lot of that action, particularly here in the US, is this company, Enphase Energy. They're a name you hear a lot if you're, looking into home solar.
For sure. A key player.
But lately, if you've been following the industry or maybe just looking at their stock, well, it's been a bit of a turbulent journey for them.
Absolutely. The long-term vision, this idea of distributed sustainable energy, it's still incredibly compelling, right? Driven by environmental goals, sure, but also homeowners wanting energy independence, resilience.
Right.
But yeah, the path to that future isn't always a straight line. Short-term market realities, economic shifts, big policy changes, they're creating some serious turbulence for companies like Enphase.
Exactly. And that contrast, that tension between this huge long-term trend and the very real short-term pain points, that's what makes Enphase so fascinating to look at right now.
Definitely.
So today, we're taking a deep dive. We got a substantial stack of sources shed by a listener, all about Enphase Energy, ticker ENPH. What kind of stuff are we actually looking at here?
It's a pretty comprehensive collection, actually, designed to give us a multifaceted view. We're pulling from recent financial reports, detailed market analysis, company profiles,
Okay.
insights from customer reviews, online forums, the ground truth, and then a whole range of analyst commentary and price targets.
So a real mix.
Yeah, it's diverse. It lets us go beyond just the headlines, hopefully, and understand the underlying dynamics.
Okay, let's unpack this. So Enphase. Many people exploring solar will know them for their microinverters and increasingly their battery storage systems.
That's their core.
They've built this reputation as a leader, especially in U.S. residential solar. But these sources, they make it clear they're navigating some pretty significant challenges right now.
They are. So the mission for this deep dive is really to sift through all this info, pull out the crucial bits. We need to understand where Enphase stands right now, really dissect their core tech strengths, identify and analyze these headwinds they're facing, the market stuff, and then try to piece together what the future might realistically hold based on their strategy and these outside factors.
It's trying to square that circle, isn't it? This company with genuinely innovative tech, what looks like a powerful long-term vision for energy,
Yeah.
but grappling with some serious short-term pain. Let's dive in. Maybe start at the beginning. Who are they? How did they build this foundation?
Agreed. Let's start right at the origin. The sources tell us Enphase was founded back in 2006. Two founders, Raghu Belur and Martin Fornage, they set up shop in Petaluma, California. And their core idea, it seems relatively simple now, maybe, but back then it was quite revolutionary for residential solar.
Which was?
Their big innovation was the microinverter. That was their flagship product, first shipped commercially in 2008.
And before that, what was the standard? String inverters.
Exactly. Most systems use string inverters. You'd connect a string of panels together in series, right? All the DC power from that string goes down to one single central inverter box, usually on the side of the house or maybe in the garage.
And that box converts it to AC power for the house.
Right. AC power you can actually use or send back to the grid. And flip that model.
How so?
Their microinverter tech. It converts the DC power to AC power right there at the individual panel level. Each solar panel basically gets its own tiny little inverter.
Okay, why was doing it at the panel such a big deal back then, and why does it still matter now?
It mattered for a few really key reasons, and these are benefits the sources still highlight today. First one is performance, especially with shading or just panel differences.
How does that work?
Well, think about a string inverter system. If even one panel in that string gets shaded maybe by a chimney, a tree branch, even just some dirt, or if one panel is just not performing quite as well as the others, it can significantly drag down the power output of the entire string.
Like the weakest link in a chain.
Exactly like that.
Got
It bottlenecks the whole series.
Ah, okay. So microinverters get around that.
Precisely. With microinverters, each panel operates independently. So if one panel is shaded or underperforming, the others just keep cranking out power at their own maximum potential.
So you actually get more energy overall from the same roof space.
Yeah, especially in real-world conditions, where you don't always have perfect uniform sunlight. It maximizes the energy harvest over the system's lifetime.
Makes sense. What else? Safety?
Safety was another huge factor. Those string systems, they carry high-voltage DC power, often hundreds of volts, all the way across the roof and down the walls.
Doesn't sound ideal.
It presents a potential safety risk, yeah, especially if there's a fire or if firefighters need to get up on the roof. Microinverters convert to standard, safer AC power right at the panel. No high-voltage DC running around up there. Much safer for installers, homeowners, emergency crews.
That's a really critical point, especially for people putting this on their homes.
Absolutely. And third, installation could be simpler in some ways. You weren't messing with those long, high-voltage DC runs. Designers had more flexibility placing panels because shading wasn't catastrophic for the whole string.
Okay, so they came in with this groundbreaking tech. They grew, went public in 2012, IPO. But the sources also talk about a really critical moment, kind of mid-last decade, a big turnaround.
Yes, this is a super important part of their story, and it highlights that resilience we mentioned. Around, say, 2017, 2018, Enphase was really facing some major headwinds. Quality issues with some of their older microinverter generations, intense price competition. The company was struggling financially. The sources really emphasized that new leadership came in. Badar took over as CEO, and they had to execute this strategic turnaround just to survive.
What did that turnaround actually involve? What did they change?
It was a sharp focus on profitability, getting operationally efficient, but crucially, a massive investment in improving the quality and reliability of the core product.
The microinverter itself.
Exactly. That led to the development and launch of the IQ series microinverters. The sources describe these as being significantly more reliable than the older ones. And honestly, this move was existential for them. Getting the product quality right was everything.
So they basically had to fix the engine while the plane was flying.
Kinda, yeah. And the sources suggest this pivot, launching the reliable IQ series, really helped them pull back from the brink of potential failure. That demonstrated ability, to fix fundamental problems and execute under pressure. That's something the material points to as maybe relevant for navigating the current challenges.
So they got the core product solid, stabilized the business, and then started expanding.
Precisely. Once they were back on solid ground, they started leveraging that position on the roof. In 2020, they launched their first home energy storage systems that became the IQ battery line. Big move into the storage market.
Which was starting to really take off then.
Absolutely.
Yeah.
Then, looking at broader trends like electrification, they diversified again in 2021, 2022. They bought Clipper Creek, a well-known EV charging company. That got them into the EV charging space.
Okay.
And alongside all this, they were pushing hard on international expansion too, really growing their presence in places like Europe and Australia.
So clearly evolved way beyond just microinverters. What's their stated mission now with this broader scope?
Their mission statement is to advance a sustainable future for all. Pretty broad.
And the vision?
The vision guiding their products is to build the world's finest network energy system and empower people to make, save, sell, and own their power. Their slogan is powering what's next.
I like that empower part in the vision. It's not just selling hardware. It's about giving homeowners control.
It is, and that's key to their strategy, creating this integrated system, giving people visibility, control. Their core business today is designing and selling these comprehensive home energy solutions. Solar, often plus storage, maybe EV charging too.
Okay, they design these cool systems. How do they actually get them built and onto people's roofs? You mentioned the fabless model.
Right, the fabless model. So they focus their expertise on the design, the engineering, the software, the brains of the operation, essentially. The chips, the power electronics, the system architecture.
But they don't own the factories.
Correct. They don't own the actual manufacturing facilities, the fabs. They use third-party contract manufacturers around the world to produce the physical hardware.
What are the pros and cons of doing it that way?
Well, the sources point to a couple of main advantages.
Yeah.
One is scalability. You can ramp production up or down more easily by working with different partners. You don't have that massive upfront cost of building your own factories.
More flexible.
Yeah, more agile, theoretically. The other pro is capital efficiency. Your money isn't tied up in plants and equipment. The big disadvantage, though, and this became really clear recently with global events.
Supply chains.
Exactly. Supply chain vulnerability. You have less direct control over manufacturing, over quality control on the line. You're exposed to risks. Your partners face geopolitical stuff, pandemics, you name it.
Okay, so the hardware gets made by partners. How does it get from there to the homeowner?
It's mostly a two-step distribution model. Enphase sells its products to a network of big distributors, like electrical supply houses or specialized solar distributors.
And they sell to the installers.
Right. Those distributors then sell to this vast global network of solar installers, the local companies who actually design the system for your house, buy the gear, and do the physical installation.
So that relationship with the installer, that's absolutely crucial for Enphase.
Critically important. The sources really emphasize this. Enphase invests heavily in training, certifying, supporting these installers. They're the front line, right? They're the ones talking to the homeowner, designing the system, putting it on the roof, making sure it works.
And the quality of that installation.
Is absolutely vital. For the system to work right, for the homeowner to be happy, we'll definitely circle back to this when we talk about customer feedback.
Where does the money come from for Enphase? Revenue streams.
Primarily hardware sales, still. Microinverters are huge, but batteries, EV chargers are growing contributors. But the sources also highlight a growing strategic focus on software and services.
Like their app, the Enlighten platform.
Exactly, the Enlighten platform. It serves homeowners for monitoring, but also installers for design, diagnostics. There's potential there for future recurring revenue, value-added services, beyond just the initial hardware sale. It's all part of building that sticky ecosystem where the value keeps going.
Okay, that gives us a really solid foundation. Where they came from, the core tech, how they operate, how they make money. Now, let's turn to the present, because the sources are very clear. They are navigating a pretty significant storm right now. What are these big macroeconomic headwinds hitting them?
Yeah, the biggest one, the one that comes up again and again in the sources impacting the whole residential solar market, is the rise in interest rates.
Ah, financing costs.
Right. Most homeowners don't just pay cash for a solar system. They finance it, take out a loan. When interest rates go up, the monthly payment on that solar loan goes up.
Which makes the whole proposition less attractive financially.
Exactly. A higher monthly payment directly hits the payback period. Makes the system seem less cost-effective, maybe less appealing compared to just paying the utility bill. This has had a direct, dampening effect on homeowner demand for new systems. Higher rates are cited as a primary driver of the current market slowdown.
And it's not just the general economy, right? There are specific policy shifts mentioned, especially California.
Yes, California's Net Energy Metering 3.0, or NM 3.0. That's been a massive policy change with profound impacts.
Remind us what net energy metering does.
It dictates how utilities compensate homeowners for the extra solar power they send back to the grid. NEM 3.0 in California drastically reduced that compensation rate.
Ouch. So sending power back to the grid became much less valuable.
Precisely. For many California homeowners, the financial equation shifted. It went from being about offsetting your own use and getting good credit for exports to being much more about maximizing self-consumption, using the power yourself, maybe storing it in a battery, to avoid sending it back at that lower rate.
And California is what, the biggest solar market in the U.S.?
Historically, yes. It's a huge market. So this change had a direct negative impact on new solar installations there, a key market for Enphase.
So you got higher financing costs hitting everyone, plus lower incentives in a major market like California, a double whammy for demand. Anything else?
The sources also mention ongoing inventory challenges in the channel. This can happen when installers or distributors built up stock expecting higher demand, or maybe before a policy change like NEM 3.0 hit.
And now it's not moving as fast.
Right now, the inventory isn't selling through as quickly because the market slowed down. Managing that channel inventory is always tricky when things are volatile.
Okay, let's look at how these headwinds are showing up in the actual financial numbers. The sources give specifics for recent quarters.
Right. Let's look at Q1 2025. Enphase reported total revenue of $356.1 million. Now, context is key here. That was actually a sequential decrease from Q4 2024, which was $382.7 million.
So revenue went down from the previous quarter.
Correct. But it was a year-over-year increase compared to Q1 of 2024. That was $263.3 million. So they're up compared to a low point last year. But the recent trend quarter to quarter is down, and that Q1 2025 number also missed analyst expectations slightly.
And zooming out, the full year 2024 number really shows the scale of the downturn, doesn't it?
Absolutely does. The sources report full year 2024 revenue was $1.33 billion. Compare that to full year 2023. $2.29 billion.
Wow, that's almost $1 billion less.
Exactly, a massive contraction. It really underscores how severe the market challenges were for them throughout 2024.
That stark difference really paints the picture.
It truly does. And breaking down Q1 2025 further, U.S. revenue was down 13% sequentially from Q4 2024. Now, there's usually some seasonality, winter installations slow down.
Sure.
But the sources explicitly link this mainly to that softening U.S. demand we talked about, rates, policy impacts.
Did international markets help offset that in Q1?
A bit, yes. International revenue saw about a 7% sequential increase in Q1, mostly driven by strong sales of their IQ Battery 5P system in Europe, especially Germany, it seems. But overall, the U.S. market decline was the bigger story for the sequential drop.
The sources also mentioned something called safe harbor revenue. What's that about?
Yeah, that's an interesting detail in the recent reports. In Q1 2025, $54.3 million of their revenue came from these safe harbor sales.
Safe harbor.
It refers to selling products to customers, usually big installers or developers, who plan to install it more than 12 months down the road. They buy it now to lock in pricing or terms, or just guarantee they'll have the product.
So it's revenue booked now, but the actual installation is way off.
Exactly. It definitely boosted the Q1 revenue number. And they expect another $40 million in Q2 from safe harbor sales. The sources kind of note a dual interpretation here. Well, on one hand, it shows they're moving product, maybe smoothing out manufacturing. On the other hand, it could signal channel partners are building up inventory that isn't getting installed quickly, which could become a problem later if end market demand doesn't pick up enough to absorb it. Analysts are watching this.
And profitability, operating income in Q1.
Non-GAAP operating income was $94.6 million in Q1 2025. That was down from $120.4 million in Q4 2024. They did cut costs, though.
Oh.
They reduced operating expenses. Non-GAAP OPEX was $79.4 million, down from $83.3 million sequentially. The sources link this to restructuring they did late last year. So they are cutting costs.
But it wasn't enough to offset the revenue drop.
Right. The impact of lower revenue, and therefore lower gross profit dollars, outweighed the OPEX savings.
And that really shows up in the overall operating margin contraction you mentioned earlier, going from like 20% down to under 7% for 2024.
Absolutely. That huge drop in operating margin really illustrates how the market downturn squeezed their profitability, even with cost management efforts.
Okay, now, let's talk about something else the sources flag as a major near-term challenge. These tariffs, especially hitting their battery business.
Okay, yeah, here's where it gets really interesting. And it's a significant headwind they're actively trying to mitigate. The U.S. imposed new tariffs on certain imported components, and these hit Enphase's battery storage business particularly hard.
Why batteries specifically, not microinverters?
Because Enphase, like a lot of companies making home batteries, sources the core battery cell packs from China.
Huh.
The sources estimate China supplies something like 90–95% of the global market for LFP cells, lithium iron phosphate, which is the chemistry Enphase uses in their IQ batteries. These new tariffs, some reportedly very high, directly increase the cost of importing those critical components.
So, heavily reliant on a Chinese supply chain for a key product that just got hit with big import taxes, what's the projected financial hit? Margins.
According to the company comments in the sources, they expect the tariffs to start hitting their gross margin in Q2 2025. But initially, maybe only about a 2 percentage point reduction.
Why mooted at first?
Because they're still working through inventory they imported before the new tariffs fully kicked in.
Got it. But the full impact comes later.
Yes. The sources project the full impact hits starting in Q3 2025. And the expected gross margin erosion, even after they potentially raise prices a bit, is projected to be a much more severe 6 to 8 percentage points.
6 to 8 points off gross margin, that's substantial.
It's a significant hit, yeah, right at the gross margin level.
Are there microinverters facing the same problem?
Fortunately for Enphase, not really. The sources say the impact on microinverters and related accessories should be minimal.
Why the difference?
Two main reasons. First, they'd already diversified a lot of their microinverter component sourcing outside of China. Second, and this is crucial, they've rapidly ramped up U.S. manufacturing for microinverters.
Right, we'll get more into that, but that protects the microinverter margins.
Largely, yes. The sources state that as of May 2025, something like 85% of their microinverter shipments were coming from their U.S. contract manufacturing sites. The rest from places like India and Mexico.
Okay, so U.S. manufacturing and diversification shield the microinverters, benefit from IRA. But the battery business is super exposed to these new tariffs because of the Chinese LFP cells. What's Enphase's plan? How do they mitigate this huge battery hit?
The strategy, laid out in the sources, is aggressive diversification of battery cell sourcing away from China.
Easier said than done, given China's dominance.
Exactly. It's not a simple task.
Yeah.
But they're actively working on it. The sources quote CEO Badri Kothandaraman saying, "We are moving with urgency. We have already identified tangible sourcing options outside China, and we are fast-tracking the qualification."
What's the timeline goal?
Their stated goal, which sounds ambitious, is to fully offset the tariff impact on battery gross margins by the second quarter of 2026. So within about a year, they need to find, qualify, and ramp up production from new battery cell suppliers outside China.
Wow. So the speed and success of that specific diversification effort, finding non-Chinese battery cells, that's absolutely critical for their margins and profitability over the next year or so.
It is arguably the single most critical operational execution challenge for them right now,
Yeah.
directly tied to their ability to stay profitable despite these tariff headwinds.
Okay, beyond the economy and tariffs,
Yeah.
who are they actually competing against day to day? What's the competitive landscape look like?
It's an intense market, and it's evolving. The sources make that clear. Their most direct competitor, especially in what's called MLPE.
MLPE. Let's define that quickly.
Good point. Module-level power electronics. It's basically tech that operates at or near the individual solar panel. Like Enphase's microinverters, or the main rival, SolarEdge, uses power optimizers. These are different from traditional string inverters that handle a whole string of panels at once.
Got it. So Enphase versus SolarEdge is the main MLPE battle. How does that stack up?
Well, SolarEdge uses those power optimizers on each panel, but they still feed into a central string inverter. Enphase uses microinverters, doing the conversion right at the panel. Together, the sources say Enphase and SolarEdge basically dominate the U.S. residential inverter market, like 90% share combined.
Wow. Has the balance shifted between them?
Yeah, there's been a noticeable shift. SolarEdge used to be dominant, say back in 2019, but Enphase has gained a lot of ground. The sources suggest Enphase now holds a slightly larger share, maybe 45–48% of the U.S. residential market.
What are the perceived pros and cons of their different approaches based on the sources? What do installers or analysts say?
Okay, so Enphase's microinverters, highlighted for true panel-level optimization, best performance in shade, superior safety with no high-voltage DC on the roof. And some recent installer feedback in the sources actually favors Enphase for improving reliability compared to some reported issues with SolarEdge inverters. Though older reports did mention potential overheating with some earlier Enphase generations.
And SolarEdge.
Their system, with optimizers and a central inverter. Sometimes they claim higher peak inverter efficiency, and their DC-coupled batteries can be more efficient for charging directly from solar. But the whole system output is limited by that central inverter size, and their standard inverter warranty is shorter 12 years versus Enphase's 25 years on the micros.
What about cost?
Generally, the sources describe Enphase systems as being more expensive upfront, maybe 15–25% higher just for the equipment, although installation factors can sometimes narrow that difference.
Okay, so that's the main fight in the premium MLPE segment. Who else is out there? Big global players.
Oh yeah. The global inverter market, including residential, is dominated by huge Chinese manufacturers. Companies like Huawei, Sungrow, Jilong, Solace, Goodwe, Growatt. Huawei and Sungrow are often cited as the top two globally overall, but that includes massive utility and commercial projects too.
How do these giants compete with Enphase, especially in residential?
Their main strength is scale and cost. They can offer products much cheaper. Historically, they focus more on string inverters for bigger jobs, but they're increasingly pushing into residential string inverters, hybrid inverters for solar plus storage, even some microinverters.
Are they a direct threat to Enphase's core market yet?
Their direct overlap in the premium microinverter space in, say, the US or Europe has been somewhat limited, partly due to maybe quality perceptions in the past, installer preference, and tariffs helping Enphase. But their growing presence and aggressive pricing definitely put broad pressure on the whole market. The sources mentioned Sungrow reportedly overtaking Huawei in overall U.S. inverter share recently, though, again, that's broader than just microinverters. As their tech improves and distribution grows, the threat could increase, especially if tariff situations change.
Any other players we should know about? Smaller competitors?
Yeah, the sources mention other microinverter players like AP Systems, Hoymiles, Chilicon Power. They often compete more on price, but maybe lack that full integrated ecosystem Enphase is building. And in batteries, new entrants are popping up. like Sige Energy with their Sige Store product, which looks like a direct competitor to integrated battery solutions like the IQ battery.
So it's a really complex competitive field. Enphase is defending its premium spot and ecosystem against a direct rival, these massive global players focused on cost, and new innovators in specific areas like batteries.
Exactly. And the competition isn't just about whose microinverter is slightly better anymore. It's increasingly about the whole package, the integrated solution, system reliability, how easy it is for installers to work with, the support network, and that end-to-end customer experience.
That leads us perfectly into Enphase's own strategy. Despite the headwinds, what are their core strengths and what are their plans for the future? How are they trying to differentiate?
Let's start by just reinforcing that core microinverter tech. It was pioneering, and those fundamental benefits, panel-level optimization, safety, detailed monitoring, there's still major advantages today.
And they keep innovating on it. The IQ8 series is the current generation.
Yes, and what's really fascinating here, a key differentiator the sources highlight is the grid-forming capability of the IQ8s.
Grid forming. Okay, what does that actually mean for a homeowner? Why should they care?
Grid forming means the inverter can create its own stable AC grid locally in your house. Normally, when the main utility grid goes down in an outage, most solar systems have to shut off for safety.
Right, islanding protection.
Exactly. But grid-forming inverters like the IQ8 can keep operating by creating their own stable voltage and frequency signal. They essentially build a microgrid just for your home's essential loads.
And the huge benefit is?
The critical benefit is that the IQ8 can provide backup power from the solar panels alone, even if you don't have a battery yet, as long as there's enough sunlight.
Whoa, okay. That's a really big deal. So my panels aren't just useless during a daytime outage if I haven't bought a battery.
Absolutely. You get sunlight-only backup. It seriously boosts energy resilience. And it can be a really attractive entry point for customers who want backup but maybe aren't ready for the full battery investment up front. They can add batteries later for nighttime or cloudy day backup. It's a strong selling point, especially where the grid isn't super reliable.
And they're using this IQ8 platform to move beyond just homes, right? Commercial market.
Yes, that's a strategic expansion. They developed the IQ8 P3P microinverter specifically for the commercial solar market. It's a move to grow their total addressable market. The sources mention specific projects using these in places like Florida, Rhode Island, California. It's a logical step using their distributed generation expertise, but yeah, it means new competitors in that space too.
Beyond the microinverter itself, the sources really hammer home this push to build a comprehensive ecosystem.
This is absolutely central to their long-term strategy and how they plan to defend their position. They're actively trying to shift from just being a component supplier to offering a fully integrated home energy management system.
And the IQ batteries are obviously a huge part of that ecosystem.
Exactly. The IQ battery line is their answer for home storage. Increasingly vital with policy shifts like NEM 3.0 and just the growing desire for backup power. They offer different sizes, modular options like the 3P, 5P, 10C, so homeowners can scale it. The current generation is the IQ Battery 5P.
But there's a new generation coming very soon.
Yes, they're about to ramp up production of their fourth-generation battery system in Q2 2025. And importantly, this is being manufactured in the U.S.
What's the big deal with this Gen 4 battery system? What's new?
The sources highlight a few things. There's the IQ Battery 10C, a larger module. There's the IQ Combiner 6C. But maybe the most innovative bit is something called the IQ Meter Collar.
IQ meter color. Sounds interesting.
Yeah. The key goal, the whole strategic point behind this new generation, is to significantly simplify battery and backup installations. And crucially, bring down the total installed system cost.
How?
They're aiming to eliminate complex, time-consuming steps for installers. Things like having to relocate the main electrical panel loads, installing separate current transformers or CTs for monitoring, running complicated high-current wiring between boxes. The meter collar seems designed to integrate a lot of that.
Ah, simplifying installation. That sounds like a direct response to some of those customer feedback issues, where problems were sometimes blamed on the install quality or complexity.
It absolutely feels like it. Make it simpler, faster, less prone to error. That should improve reliability and the customer experience. But maybe even bigger, simplifying installation helps cut the soft costs of solar and storage.
Labor, permitting, inspection.
Right. All those costs that are a huge chunk of the total price.
Right.
If they can cut those, it makes storage more affordable, more accessible to more people,
Yeah.
which could help drive market demand itself.
They've also pulled EV charging into this ecosystem.
Yes, through buying Clipper Creek, they offer Level 2 IQ EV chargers. The value proposition is the integration. The charger works seamlessly with the rest of the Enphase system. You can monitor your EV charging, maybe set it to prioritize using your surplus solar power, all through the Enphase app.
And the software, that Enlighten platform, is the glue holding it all together.
Precisely. Enlighten is the central nervous system. It's the app homeowners use to see what their system's doing, production, consumption, battery status. But it's also a powerful tool for installers. System design, remote monitoring, diagnostics, troubleshooting. It's key to that integrated experience and seen as a potential source of future recurring revenue as they add more software services.
Is there a next-gen microinverter coming after IQ8?
Yes, the sources mentioned the IQ9 microinverter is on their future product roadmap. So continued innovation on the core tech.
Okay, so the big picture strategy is crystal clear. Build this comprehensive integrated home energy management system. Why is that so critical for an Enphase future?
It's critical for multiple reasons, as the sources lay out. First, it boosts customer value. You get one unified system that works together, hopefully seamlessly, instead of patching together bits from different brands.
Makes sense.
Second, it increases stickiness. Once you have Enphase microinverters, batteries, maybe a charger, all run by their app, the cost and hassle of switching to a competitor goes way up.
Okay, cool.
To a degree, yeah. Third, it helps defend against commoditization. Hardware components can become commodities over time, competing just on price. By offering an integrated system with smart software, they move up the value chain.
And it's a way to sell more stuff to existing customers.
Exactly. It's a classic land and expand strategy. They land with the microinverters, they have a huge installed base, then they can expand by selling batteries, chargers, software services to those same customers. The sources see this integrated ecosystem as a more defensible, higher margin growth path long-term than just selling microinverters alone.
But you mentioned earlier managing all this complexity. That's also a challenge, right?
It absolutely increases operational complexity. Making this strategy work means seamless integration between all the hardware and software, robust support for a wider product range, making sure installers are trained and proficient on the whole system, not just one piece. It's a much heavier lift.
Let's circle back to that U.S. manufacturing push and the IRA. You said it's strategic, helps with supply chains for micros, boosts margins.
It is a massive strategic shift, really catalyzed by the incentives in the U.S. Inflation Reduction Act, the IRA, specifically those Section 45X manufacturing tax credits. Enphase moved aggressively to scale up U.S. manufacturing with contract partners in places like South Carolina and Texas.
How much of their microinverter production is U.S.-based now?
The sources said as of May 2025, around 80% of their microinverter shipments were coming from U.S. facilities. They shipped a huge number in Q1 2025 alone, 1.21 million U.S.-made micros. And they've started U.S. production for the IQ Battery 5P, and that new Gen 4 battery is ramping up in the U.S. too.
What's the actual financial impact of that IRA tax credit? How big a deal is it?
It's very significant, huge. In Q1 2025, the benefit from the 45X credit was $37.9 million. And crucially, that represented 10.6% of their non-GAAP gross margin that quarter.
Wait, over 10% of their gross margin came from that tax credit?
Yes. Over 10 percentage points. They expect another $33 million benefit in Q2. It's a massive boost to their reported gross margins, makes them much more cost competitive in the U.S. versus imports. And it's a huge help in de-risking their supply chain from tariffs and geopolitics, especially China, for the products they make here.
Are there other IRA benefits?
Yeah, there's also a domestic content bonus credit for solar projects that use enough U.S.-made gear. Enphase's U.S.-made products, their DOM SKUs, help projects qualify for that extra incentive too.
Is there any downside to this big U.S. manufacturing push? Any risks?
Yes, the sources mention one potential risk. Setting up and running this domestic capacity, even with partners, involves higher fixed costs compared to just using overseas factories. If U.S. demand doesn't recover strongly enough to keep these U.S. lines running at high volume,
then those higher costs could hurt profitability.
Right, those higher fixed costs could eat into margins and maybe offset some of the IRA benefit. The net positive effect really depends on maintaining high production volumes here in the U.S.
Okay, beyond the U.S., they're also looking hard at international markets and that commercial segment for growth.
Absolutely. International expansion is key to diversifying revenue, reducing reliance on the currently tough U.S. market. Europe is a major focus. Sources say it's driving significant sales, especially the IQ Battery 5P in Germany. They're also launching products tailored for Europe, like balcony systems in Belgium for apartments, and rolling out their newer EV charger there.
What about other parts of the world?
Australia is highlighted. Government incentives there. They're engaging installers, launching products. India is seen as this potentially huge future market, showing early traction. And Latin America, Brazil likes their microinverters for fire safety rules. Puerto Rico needs resilient battery systems because of grid issues.
And the commercial entry, just to recap.
Right, the IQ8P3P microinverters and related gear, pushing into commercial buildings, small businesses, logical adjacency, leverages their tech. But yeah, different competitors, different sales cycle compared to residential.
This all sounds like a very active strategy on many fronts. How are they managing all this expansion? New products, new markets, software? Acquisitions and partnerships seem important based on the sources.
Acquisitions have definitely been a major tool for them to quickly grab technology or market access or specific capabilities. We mentioned Clipper Creek for EV charging. Earlier, they bought parts of SunPower's microinverter business, which boosted their patents.
And software companies seem to be a real focus for acquisitions lately.
They are, increasingly. Buying companies like Sofdesk and DIN Engineering gave them design software tools for installers. More recently, acquiring Greencom Networks in Germany brought expertise in energy IoT Internet of Things and home energy management software. These are crucial for building out that whole integrated ecosystem vision and creating potential for recurring revenue down the line.
So it's not just adding hardware, it's about integrating intelligence control.
Exactly. It's about making the whole system smarter, as Chief Products Officer Raghu Balur puts it in the sources. Acquisitions like Greencom help them connect and optimize not just their own gear, but maybe third-party devices in the home too. Heat pumps, smart appliances, all managed through the Enphase app, potentially.
Do partnerships play a role too?
Yes. One example mentioned is partnering with Home Connect. That's a platform used by appliance brands like Bosch and Siemens. The idea is the Enphase app could talk to these appliances, maybe run the dishwasher automatically when your solar production is high or electricity is cheap. More value for the homeowner from the integrated system.
So the pattern is clear. Use acquisitions and partnerships to accelerate the shift towards being this comprehensive home energy management provider. Expand capabilities, expand reach.
Precisely. It's about building out all the pieces of that ecosystem much faster than they could organically, and making the whole offering more valuable than just the sum of its parts.
Okay, wow. We've covered the foundation, the big challenges, their strategic response, future plans. Now let's pull back the curtain even further. Let's look at the nitty-gritty financials, the overall health of the company, and crucially, how customers and investors are actually feeling about them right now.
All right, let's revisit those financials, especially margins, because they tell such a critical story at the moment. We saw Q1 2025 non-GAAP gross margin was 48.9%.
And you stressed, without that IRA benefit, it would have been way lower, 38.3%.
Right. Now compare that to Q4 2024. Non-GAAP gross margin then was 53.2% total and 39.7% excluding IRA. So even with the big IRA help, the overall gross margin actually decreased sequentially from Q4 to Q1.
Why was that?
The sources attribute that sequential dip to a couple of things. The IRA benefit was slightly smaller dollar-wise in Q1 versus Q4, and they had an unfavorable product mix in Q1, meaning they sold a different proportion of higher versus lower margin products. But it really drives home that dependency. Over 10 percentage points of their reported margin in Q1 came directly from that government incentive.
And now the battery tariff impact is looming. That 6 to 8 percentage point hit starting Q3, that's a huge cloud over future margins.
Absolutely. Their ability to pull off that battery supply chain diversification and offset the tariff hit, that's directly tied to whether their gross margins can stabilize or recover over the next year or so. Huge execution test.
What about operating expenses, the cost of running the business?
As we mentioned, they did cut OPEX. Non-GAAP operating expenses in Q1 2025 were $79.4 million, down from $83.3 million in Q4 2024. That reflects those cost-cutting and restructuring actions, including layoffs. Yeah. So they are actively managing costs in this lower revenue environment.
But operating income still fell.
Right. Despite the savings, operating income still declined sequentially because the drop in revenue and the resulting gross profit dollars was just bigger than the OPEX cuts.
How did that flow through to the bottom line? Net income, earnings per share, EPS.
In Q1 2025, their non-GAAP EPS was $0.68. That actually missed the analyst consensus estimate slightly, which was around $0.71. For comparison, their GAAP EPS, the standard accounting number, was much lower, 22 cents.
Can you quickly remind us why the big difference between GAAP and non-GAAP?
Sure. GAAP is the standard accounting rules. Non-GAAP figures usually exclude certain items management feels aren't part of core ongoing operations. For Enphase, big exclusions are often stock-based compensation expense, costs related to acquisitions, restructuring charges. Investors often look at non-GAAP for underlying performance, but you need to know what's taken out. Here, the gap between $22 GAAP and 68 cents non-GAAP is significant, mostly due to stock compensation and how the IRA benefits are treated. Looking back, their trailing 12 months, TTM GAAP EPS is on $1.11.
How's their cash flow holding up through all this? Are they burning cash?
Actually, positive cash flow generation is highlighted as a definite strength in the sources, even now. In Q1 2025, they generated $48.4 million in operating cash flow and $33.8 million in free cash flow.
Free cash flow being operating cash minus capital spending.
Exactly. Capital expenditures were $14.6 million, up a bit, maybe tied to that U.S. manufacturing build-out. But generating consistent free cash flow like this gives them financial flexibility to invest in R&D, manage debt, maybe return capital to shareholders. It's a positive sign.
Speaking of the balance sheet, liquidity, debt.
Their balance sheet looks pretty strong on liquidity. They had $1.53 billion in cash, cash equivalents, and marketable securities at the end of Q1. That's a healthy cushion. And a good move they made in Q1 was fully paying off a $102.2 million convertible senior note that came due. That reduces their overall debt.
What about their overall debt level, debt to equity ratio?
The sources note their debt to equity ratio is currently somewhere between 134% and 152%, depending on the calculation. That's generally higher than many tech peers, maybe not totally out of line for a hardware company in this space dealing with growth cycles. They still have other convertible notes due in 2026 and 2028. It's something to watch. They have cash, but servicing debt relies on profitability, which is under pressure. But paying off that recent note was a positive deleveraging step.
Are they using cash to buy back stock, returning capital to shareholders?
Yes, they have an active stock repurchase program. Board authorization up to $1 billion through July 2026. And they were active in Q1 2025, bought back about $100 million worth of stock. That was around 1.6 million shares at an average price of $62.71. They also handle stock withholdings for employee taxes, which also reduces the share count.
What does buying back stock signal when the market's tough like this?
Generally, it signals management confidence. They believe the stock is undervalued compared to its long-term potential. Buying shares now, using their cash, suggests they see value even with the headwinds. It can help boost EPS later if the stock recovers. It's a choice using cash for buybacks versus debt repayment or more R&D, but it signals confidence in the current price.
Any interesting tidbits from recent insider trading activity in the sources, executives buying or selling?
Yeah, the sources provide some details. Notably, the CEO, Badri Kothandaraman, made several open market purchases of Enphase stock over the last 6 months or so, totaling almost $800,000. CEO buying is usually seen by investors as a pretty strong positive signal.
What about others? Any significant sales?
The CFO, Mandy Yang, had a sale around $83,500. But the sources clarify this was tied to tax withholding for vested stock units. That's super common for executives, basically automatic, not seen as a negative signal. A director, Terman Rogers, did have a much larger sale, $6.1 million. That's more notable. Large director sales can happen for many personal reasons, diversification, etc., so it's hard to read too much into it without context, but it's a data point. Overall, though, institutional ownership is still very high, like 78%.
Okay, so the financials. It's a mixed bag. Hit hard by the downturn, margins heavily reliant on the IRA, facing new tariff pressure. But still generating cash, managing debt reasonably well, and some signs of management confidence.
Now,
Let's get to the ground level. What are customers actually saying? What do reviews, forums tell us about the real-world experience?
looking at that customer feedback from forums and reviews, the picture is definitely mixed. You see both real satisfaction and significant frustration. On the plus side, many users report years of reliable, flawless operation. You see comments like "never been down" or calling their system solid. These happy users often point to good installation quality and the tech benefits, like handling shade well.
But there are definitely negatives reported too.
Oh yes, some users report recurring issues, which is always concerning. Component failures, the gateway, which is the communication hub, the system controller, even battery modules needing replacement, sometimes repeatedly.
That sounds frustrating.
Extremely. One user in the sources was quite blunt, saying their system has not made it more than 6 months at time without needing some intervention. That points to persistent problems for at least some customers. App inaccuracies also get mentioned in the app, showing normal status even when panels are down. Communication issues, like Bluetooth range for setup.
What about customer service when things do go wrong?
Again, very mixed experiences reported. Some positive, saying Enphase support was proactive, resolved issues well, maybe sent to tech with parts. Others, very negative. Descriptions like hopeless, especially mentioned in relation to Australia. The Better Business Bureau, BBB, complaints echo themes like communication problems, delivery issues, installation delays, often the installer's fault but reflects on the system, responsiveness challenges. It's worth noting one BBB link was actually for an installer using Enphase, so the lines can get blurred.
So it really seems there can be this gap between the promise of Enphase's advanced tech and the actual day-to-day experience for some users.
That definitely seems to be the case based on this feedback. And a crucial point, highlighted by users and even installers in these forums, is that problems are frequently blamed more on poor third-party installation quality than on the Enphase gear itself being fundamentally bad.
Back to the installer relationship being critical.
Exactly. Since Enphase relies on this network of independent installers to put in these complex systems, problems during the install can directly lead to performance issues and unhappy customers, even if the hardware itself is okay.
Makes total sense. Even the best gear won't work if it's not installed right. Any data on warranty claims?
The sources mentioned that back in 2022, Enphase booked $21 million in warranty claim expenses and significantly increased its warranty accruals money set aside for future claims by 150% to $46 million. The company linked this mainly to changing estimates, rising costs, and past sales growth, but it's data worth considering alongside the customer feedback. It suggests managing reliability and warranty costs is a significant operational factor, especially as they scale.
So the overall takeaway on customer experience seems to be potential for excellence, long-term reliability if installed well, but definite pain points around component reliability for some, software glitches, and a heavy reliance on the variable quality of that third-party installer network. And as Raghu Bulur was quoted saying, if you deliver the best customer experience, everything else follows. This feedback suggests getting that consistently right is still a key challenge.
It's absolutely vital. Consistent, good experiences drive loyalty, referrals, which are huge in residential solar, and reduce support costs. Bridging that gap between the sophisticated tech and flawless real-world execution via the installer channel, that's key for their long-term success and defending that premium brand image.
Okay, with all this going on, market struggles, tariffs, big strategic bets, mixed customer feedback, how are investors feeling? What's the general sentiment around Enphase?
Investor sentiment, reflected in the sources, is pretty mixed right now, directly mirroring that high uncertainty we've been talking about. You definitely have the long-term bulls who are still optimistic.
What are they saying?
They see the trend to localized energy as inevitable. They believe Enphase is the tech leader in household solar. And they view the current stock price, which is way down from its highs, as maybe a fantastic price to buy in long if you have that multi-year view. They argue the stock has been beaten down.
But on the other side, there's a lot of caution, skepticism too.
Definitely. Near-term skepticism is fueled by the stock's really poor performance over the past couple of years. Horrific stock for years, was one sentiment expressed. Reports of market difficulties, like one comment about a giant shit show in Europe, although recent results showed growth there, so conflicting views. And ongoing worries about valuation. Even now, the trailing PE is still above 30, which some see as high given the lower profits.
What about the professional analysts, the ones covering the company for investment banks?
Their commentary reflects the same split personality. Ratings are all over the place, buy, neutral hold, even some underweight and sell ratings. The trend over the past year has generally been analysts downgrading ratings and cutting price targets as the downturn dragged on and tariffs emerged. And the dispersion in their 12-month price targets is really wide.
Like how wide?
You see targets as low as around $31 on the pessimistic end and as high as $125 on the optimistic end. The averages tend to cluster somewhere in the low to mid $50 right now. It just shows a real lack of consensus.
What are the main arguments driving those different analyst views? Why the caution versus the optimism?
Okay, the cautious analysts point to the continued slow U.S. residential demand, the big hit to margins coming from battery tariffs in Q3, ongoing policy uncertainty like potential IRA changes or more NYUM-like rules popping up, and intense competition squeezing prices and share.
And the optimistic arguments?
They focus on Enphase's tech leadership. The IQ8, the IQ9 coming, that ecosystem, the potential for a market recovery eventually, growth from new products like the Gen 4 batteries, and the real benefits from U.S. manufacturing and the IRA, assuming those continue. For example, Morningstar recently cut its fair value estimate to $50. They read it fairly valued, but interestingly, give it no economic moat and a very high uncertainty rating, They think the stock's weakness is less about the coming tariffs and more about the delay in demand recovery. Another source, Minichart, has a hold rating around $47, explicitly highlighting that tension between the long-term promise and the significant near-term challenges.
So that Y range of targets, the very high uncertainty rating, it really just underlines how tough it is to predict the near-term path and how differently people weigh the risks versus the potential.
Exactly. Analysts are making different bets on when the U.S. market recovers, how well Enphase handles the tariff mitigation, and how effectively they execute this complex growth strategy. Lots of moving parts.
Let's look at the current valuation in light of all that. Where's the stock trading now, and what do the valuation metrics look like?
As of early June 2025, the stock was hovering roughly between $39 and $44 a share. That gives Enphase a market cap around $5.4 billion. And it's crucial to remember this is way, way down from its 52-week high, which was over $140.
Oof, a huge drop from the peak. What about standard valuation ratios like price to earnings, PE?
The trailing 12 months TTM gap PE, based on that $1.11 TTM EPS we mentioned, is relatively high, around 37-38 times earnings. That might look rich given the current struggles. However, analysts also look at the forward PE, based on expected earnings over the next year.
And what's that look like?
That's much lower, somewhere around 18-20 times expected earnings. This reflects analyst forecasts for earnings to recover somewhat from the current low point. It's also way below Enphase's historical average PE multiple, which is closer to 49x. So the market has priced in a lot of the current pain and lower profitability expectations compared to the past.
Any other metrics? Price to book, price to sales.
The sources cite price to book around 7.29, price to sales around 4.16. These also show it's trading at a premium compared to many industrial companies, reflecting the tech focus and growth hopes, but again, significantly down from past highs.
So the current valuation being so much lower than the highs, it suggests the market is heavily factoring in the headwinds, the profit hit. Does that make it an opportunity? Or is the uncertainty still too high?
That's the million-dollar question, isn't it? And the sources offer different perspectives. The valuation reflects much lower earnings now, but anticipates some recovery based on that forward PE. It could be an opportunity if that recovery happens, if they navigate the tariffs, if they execute. But that very high uncertainty rating, the significant risks, it means the stock remains super sensitive to bad news, more delays, or execution stumbles. Feels very much like a high-risk, potentially high-reward situation, depending heavily on your time frame and risk tolerance.
Which brings us to our final section, the path forward. What is the growth potential? What's the outlook based on these sources?
Well, the growth potential is fundamentally tied to that massive, long-term global shift towards distributed solar and storage. Enphase has identified several key levers to try and capture that growth, which we've touched on.
Let's just quickly recap those main growth levers.
Right. Geographic expansion, Europe, Australia, India, Latin America. Continuous product innovation, IQ8, IQ9, next-gen batteries. Leveraging U.S. manufacturing and those IRA benefits. Entry into the commercial market. Growth via strategic acquisitions and partnerships, building the ecosystem. And longer-term potential software and services monetization.
The sources also attempt some projected stock price scenarios based on different assumptions. We need to stress these are highly uncertain projections.
Absolutely. Crystal ball gazing, especially in a volatile sector like this, is tricky. But the sources do lay out a base case scenario to give a sense of what could happen if things go reasonably well.
What does that base case look like 1 year out? Mid-2026.
The base case projection for mid-2026 is around $55 per share. The thinking behind that assumes a modest recovery in the U.S. residential market, enough to start using that U.S. capacity better. It assumes Enphase makes good initial progress mitigating the battery tariffs with new suppliers. Assumes international growth continues and the IRA benefits stay stable. That target is usually derived by putting a reasonable PE, multiple maybe low 20s, reflecting some recovery but still cautious on expected EPS for fiscal 2026, assuming earnings bounce back from the current lows.
Okay, looking further out, 3 years. Mid-2028.
The base case projection for mid-2028 moves up to around $80 per share. This assumes a more solid, sustained recovery in U.S. residential, assumes they execute well internationally and in the commercial market, assumes new products like IQ9 and Gen 4 batteries are really contributing. This is often based on applying a slightly higher but still maybe conservative PE of 18-20x to analyst consensus EPS for 2027, which averages around $3.92 in the sources, and maybe projecting that grows to over $4 by 2028.
And the longer view, 5 years. Mid-2030.
For mid-2030, the base case projection is around $120 per share. This scenario assumes Enphase maintains its leadership, sees real growth from software and services, and fully benefits from those big trends of electrification and decarbonization driving demand for their whole system. This projection needs significant EPS growth, with forecasts potentially hitting $7 to $9 per share by 2030 and applying a PE of maybe 15-18x, reflecting a more mature company by then.
So these base case numbers show a potential path for significant recovery from today's price. But they rely on a lot of things going right.
Absolutely. The sources stress these are projections. Hitting even the base case, let alone higher scenarios, requires near-flawless execution across the board. Plus, a favorable market and policy environment demand recovers, tariffs get mitigated, IRA stays put.
And the sources also mention the sheer range of possibilities beyond just this base case. Bear and bull scenarios.
Yes, they really highlight the huge dispersion in long-term forecasts, especially for earnings per share. Analysts see EPS by 2029-2030 ranging from maybe $3.50 in a bear case to over $16 in a bull case. That translates into potential 5-year stock price outcomes anywhere from maybe $70 to over $250. Just shows how wide the potential future paths are and how sensitive it is to execution in the market.
What are the key risks that could derail even the base case, pushing things towards that bear scenario? Let's summarize those.
The sources boil it down to several key risks. Most immediate. Prolonged demand downturn, the market just stays weak for longer. Policy risk changes to the IRA. More bad NEM rules in other states. Competition intensifying price wars. Losing share to the big global players. Operational risks fumbling the supply chain shift for batteries, manufacturing problems, ongoing reliability or customer experience issues. And financial risks, continued margin pressure from tariffs or competition. Trouble managing debt if profits don't recover. These risks are real, they're significant. It's why analysts have that very high uncertainty rating, why the stock is where it is.
Okay, switching gears slightly for the final points. ESG, environmental, social governance. Their core business is clean energy, seems inherently positive environmentally.
Yes, the sources confirm that. Their fundamental business making tech for solar and storage is good for the environment. They're also formalizing their ESG reporting and oversight. Sources say ESG oversight happens at the board and executive levels, and they publish annual ESG reports.
How do the ESG rating agencies view them?
Generally pretty well. MSCI gives them an AA rating, which is leader category. Sustainalytics rates them low risk, score of 19.90, close to negligible risk. ISS gives them a prime rating. So solid external validation.
What specific environmental impacts or goals do they mention?
They highlight the positive impact of their installed base, like 107 terawatt hours of clean energy produced globally by late 2024, preventing an estimated 72 million tons of CO2 emissions. Operationally, they have climate targets, aiming to cut their Scope 1 and 2 emissions intensity by 30% by 2030. They're working on using more renewable energy themselves, improving efficiency.
And social and governance, the S&G.
Socially, focuses on talent, diversity, equity, safety. They have human rights policies, supplier codes, governance-wise, frameworks for risk management, compliance, responsible sourcing. One source, Minichart, did offer a critique. A leader on governance, but rated below average on toxic emissions waste compared to peers. Suggests room for operational improvement there.
So ESG seems genuinely integrated into their strategy, not just box ticking.
The sources suggest it is. They assess climate risks, link ESG goals to exec pay, align disclosures with frameworks like TCFD. It seems tied to their overall mission.
Oh, right. Wow. We have extracted a ton of information from this listener-provided stack of sources on Enphase Energy, from their pioneering start, the tech, the huge current challenges, their strategic responses, the financials, customer views, investor sentiment. Let's try to synthesize this. What's the bottom line, the investment thesis based on all this?
Okay, at its core, the sources paint Enphase as a company with clear strengths. Tech leader in a critical growth area, distributed solar and storage. Strong brand. Actively building that integrated ecosystem. Made smart moves like scaling U.S. manufacturing to grab IRA benefits and hedge supply chains.
But those strengths are being seriously tested right now by these near-term pains.
Unquestionably. The sharp demand slowdown, especially in the U.S., from rates and policy, that hammered revenue and profits. And now these new battery tariffs create this immediate, major threat to margins starting Q3, demanding aggressive action. Plus, it's a tough, competitive market.
So the investment thesis, as it comes through in these sources, it really hinges on believing in that long-term trend and Enphase's ability to navigate this storm.
Exactly. The bullish thesis relies on believing the decades-long shift to decentralized clean energy and electrification is unstoppable. And believing Enphase, with its tech and integrated strategy, is uniquely positioned to win long-term. But, and it's a huge but, you also have to believe management can execute through this downturn, solve the battery tariff puzzle via diversification, and successfully deliver on this complex strategy across products, software, and global markets.
Given that balance, big potential versus big near-term risks, who is this stock really for, based on this analysis?
It seems geared towards investors with a genuinely long-term horizon, thinking 3, 5, maybe more years out, and crucially, a high tolerance for volatility. The current price likely reflects a lot of the bad news, but the high uncertainty and real risks mean more bumps are possible, even likely.
What would be the key green shoots, the catalysts that could signal things are turning and maybe lead to a stock re-rating?
The sources point to several key things to watch for. A sustained real recovery in U.S. residential solar demand. That's critical. Clear success and progress in mitigating the battery tariffs by shifting supply chains away from China that would ease margin fears. Continued strong growth internationally, proving diversification works, and positive market uptake of their new products, especially that Gen 4 battery system and eventually IQ9, showing they're still innovating and winning.
And without those catalysts, or if the risks worsen, the path looks much tougher.
That's the crux of it. Compelling long-term story, strong tech, smart strategy, but facing very real, significant near-term hurdles. Execution over the next 12-18 months, especially on tariffs and navigating demand, feels absolutely critical. Cautious optimism seems warranted based on the potential, but heavily tempered by those risks.
It really is a fascinating picture. A company right at the forefront of the future of energy, technologically, but grappling with these powerful, immediate market and policy forces. We've taken a really deep dive into this stack of sources on Enphase Energy today, explored the history, the tech, the current major challenges, their strategy, financials, and how everyone from customers to analysts sees them.
It truly highlights just how complex this renewable energy transition is, the interplay of tech, economics, policy, global supply chains, execution. It's all in here.
Exactly. Now, thinking about everything we've covered, especially that strategic push for an integrated ecosystem and simplifying installation to drive adoption, let's consider the potential impact of that upcoming fourth-generation IQ battery system, specifically components like that IQ meter collar, designed to make backup installations way simpler and maybe cheaper.
Right, reducing complexity.
What if those kinds of seemingly small, practical, technical innovations aren't just about competing better on features, but are actually key to fundamentally changing the total installed cost and the ease of putting in home energy backup? Could making the installation dramatically simpler and cheaper, even if the box price isn't the absolute lowest, be the thing that truly unlocks mass adoption of batteries? And in doing so, accelerates the very market recovery and growth Enphase needs.
That's a really powerful thought. It shifts the focus, doesn't it? From just the price tag on the battery itself to the total cost and hassle of getting the whole backup system working in someone's home. If they can significantly lower those labor and complexity barriers, yeah, that could be a major unlock for the entire market, not just for them.
It makes you wonder what really drives adoption in these complex tech rollouts. Is it just cost per watt, cost per kilowatt hour, or is it also about the ease, the reliability, the total solution experience for installers and homeowners? What stands out to you most from this deep dive into Enphase?